I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Hilliard MacBeth, author of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. Welcome back to the show, Hilliard.
Always nice to be on your show.
Real estate in Alberta, we thought the prices would plunge dramatically because of the cutbacks in the oil industry, but did they, and do they expect a comeback from the prices that did come down?
Well, plunge definitely did not happen. There's definitely some weakness. The prices in Calgary, for example, on single-family homes indicate about a 5% drop, and on condos about a 10% drop. And that's not the whole story, obviously, because there's obviously distressed properties that sell, sometimes very expensive properties that sell through the foreclosure market or auctions or something, and they don't get counted in the index. But and of course, if you have a very expensive property in Edmonton or Calgary, it's very difficult to sell right now. So what would be the price if you got a $2 million home and you've had it listed for a year? And if you absolutely had to sell it, you might have to take a 50% cut on it. But most people won't do that, so they just sit on it and wait. And so we're kind of in that phase, but this phase has lasted way longer than I would have thought, given the severity of the recession that we're in. I would have expected that prices would be down quite a bit more than 5 or 10% in the last couple of years, and I think eventually they will be. But obviously, the people that need to sell are able to wait, with the idea they're going to get their price sooner or later. Eventually, the reality will sink in that they're not going to get their price, and if there's no rebound, of course, and then they'll have to cut their price, or maybe their lender will force them to cut the price. It just depends on every circumstance is different. But a week ago, I checked the Boardwalk website and all their investor information, because it's a publicly traded company, and they have a large number of units in Alberta. They're probably the biggest landlord in Alberta. And their share price hasn't dropped that much yet. It's down, but it's not down much. It's down about 15-20%. But their rents are coming down very rapidly for their units. Their units generally are valued at about $170,000 down to about $120,000. But they're only able to get $1,100, $1,200 a month for a 2-bedroom, and they have to give incentives. They have to give 1, 2, 3 months of free rent in order to keep their people. They're going back to their current renters and saying to them, we'll if you just stay, we'll give you 3 free months rent. And they mentioned that in their quarterly report. So that's pretty desperate. And I don't see that turning around, because what came out today was the housing starts, and for the third month in a row, Canada-wide, there's over 200,000 starts in the months December, January, and February, and that's well above the rate for the last several years on average. So there's new supply coming on the market every day in Edmonton and Calgary, and there's a shortage of tenants to take to move into the properties. So it's a very volatile situation, and I would expect that we'll see much bigger declines before this is over. Boardwalk, the stock topped out at $70 around September 2014, which is around the time that the oil price was really starting to come down, and it's now at $44.38. So it's a good drop of more than 33%. But they're struggling for sure.
Why would they be building more space in Edmonton and Calgary? Are they just totally optimistic that things can turn around and for a long time?
I think there's a lot of optimism that by the end of this year, things are going to come back. The oil, up until today, when we had a big drop in the price of oil, but prior to today, the oil price had kept above 53, 55, and people were talking about the drilling rigs coming back and prices going up, and the OPEC cuts were going to get the market back into balance, and demand still growing. And it's not my view, but it's certainly a very widespread view held by people. Whether it's just optimism driven by a necessity because these people are stuck with a bunch of assets and they need that to happen, or whether it's genuinely held. But it just doesn't make sense. ExxonMobil just announced a couple of weeks ago that they are removing all of the reserves that are attached to the Kearl project, which is over 3 billion barrels of reserves in northern Alberta near Fort McMurray. Removing them under the rules, if they're not economic, they're required to remove them from their proven and probable reserves. So their total worldwide reserves are about 20 billion, and 3.5 of them were removed in Alberta as uneconomic. Now, that doesn't mean the Kearl plant would shut down. It's still going to be operating, but the reserves that they had booked for that were uneconomic, so they had to remove them. And they've added 6 billion barrels of oil in the Permian Basin in West Texas, which is just on the border between Texas and New Mexico. Prices, the cost of producing a barrel of oil in the Permian Basin has come way down. It's the hottest play in the world, and it's got the advantage of being close to tidewater, close to pipelines, close to the market. And, of course, with the new administration in the U.S., perhaps there'll be some incentives for people to buy American rather than Canadian. And so it's very dangerous for Alberta. The competition is very tough. It's really tough to compete with heavy oil from northern Alberta against light oil in Texas, and the wages are lower down there. One of the reasons the costs have come down is the wages are lower. The other reason is that technology in the fracking and the shale is moving ahead very rapidly. They're finding better ways to do it with better equipment. They're learning all kinds of tricks how to get more production out of these wells. So there's a lot of Alberta companies that are going down to the U.S. to get in on this boom that's happening down there. But that doesn't help Alberta. So I don't see where the optimism is coming from. Really, it's not. There doesn't seem to be anything well founded there. I gave a presentation today at lunch at the Economic Society of Northern Alberta, and I had to update my slides in order to do that. And it certainly seemed like the news, if anything, was a little bit worse than it was the last time I gave the presentation a couple months ago.
Where are things going really bad, and why are they still optimistic?
I don't really know why they're so optimistic. I think it might be a wishful thinking thing more than anything else. And one of the biggest risks to the Alberta economy isn't even in oil and gas. In the construction industry, which is one of our biggest industries in Alberta, we had about 275,000 people employed at the peak, and it's now down to 242,000. But I look back to 2005, and it was about 150,000 at that time. So we'd have to lose almost another 100,000 workers to get back to 2005. And as the projects wind up, there's a huge development project in Edmonton called the Ice District with several towers going up. There's a huge amount of construction going on in downtown Calgary of new office buildings, but they already have a 25% vacancy in office buildings in Calgary. So these were decisions that were made 3 years ago before the oil price dropped, and now they're completing the project, and the work's being done. But once the project is complete, then that'll be it. And then in the oil sands, there's one plant still under construction called the Fort Hills plant. It's a $15 billion plant similar to the Kearl plant that was completed a year and a half ago by ExxonMobil. This one is Teck is involved in it, and I think Shell and a couple other, Total maybe. And anyway, once that one's built, I think that'll be the last one for a long time, other than maybe minor expansions and that sort of thing. And then there's a Northwest Upgrader, which is actually a government-backed program in just northeast of Edmonton in a place called Redwater, which is about an $8 or $9 billion project. And each of these projects has 5,000 or 10,000 people attached to them. But once they're finished, they will those people will be they'll be let go as the project ends, and then the question is, what will there be to replace that? And there isn't really anything on the deck. So one of the ways to look at it is the design people. So the engineering, architect, and design people have to work 2 or 3 years out ahead of the actual project. And there's really no, I'm told from people in that industry, there's nothing on the horizon for 2017. So it's extremely unlikely to get a really strong bounce back in the construction industry by the end of 2017, because there's really no design work underway right now, and more likely that we'll have a further slump. So, I mean, there is the federal government infrastructure program, and we do have some projects in Edmonton and Calgary that have been labeled, and the city of Edmonton and the province of Alberta, city of Calgary have all chipped in, and the federal government thinks putting in 2/3 of the money. Edmonton's an LRT project, but that's not going to be that huge. That's not nearly big enough to replace a major oil sands plant or major office towers in Calgary. Those are big projects, and they won't be easily replaced.
We'll have more with Hilliard MacBeth right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the 4th largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome back. We're speaking with Hilliard MacBeth. Hilliard, are Albertans hardwired to be optimistic?
Yeah, well, that's a great question. I think they are. I've been really struggling with this discrepancy between the facts on the ground and the way Albertans think. And one of the indicators that Albertans are optimistic is when you look at CMHC insurance. Up until the downturn started at the end of 2014. And even into 2015, after the oil price had already dropped quite a bit, Albertans were still taking 23% of the CMHC insured mortgage financing, with only 11.5% of the population. Now, part of that is housing. They were buying more expensive houses in Alberta than on average across Canada. But part of it, I think, is the young people in Alberta are much more likely to go out and take on a big debt than most people across Canada, because they tend to be well paid. They have good jobs, and now this is all from 2 years ago, and they didn't really see anything on the horizon that would throw a damper on that. And I think that optimism continues today. I'm amazed at how busy the restaurants and the bars and the hockey tickets. I was talking to some guys that go around. There's 4 of them from New Brunswick and Eastern Canada, and they're going around all the NHL hockey arenas to see a game. And their goal is to see. I think they've only got 2 left that they haven't gone to, and I don't know what they'll do when they finish. But anyway, they've been doing this for years, obviously. And so I asked the guy. I was talking to them at the restaurant, and I said, "Are Edmonton hockey prices the same as elsewhere?" He said, "Oh no." He said, "They're way higher." He said, "They sit on the upper bowl, and in Edmonton it's $130, and at practically all the other rinks in the system it's $80 for the same seat, roughly the same seat." And he said Edmonton prices are the highest in the whole system of I don't know how many 30 rinks all over North America. So there's just one indication, and the place is full, and you look around the room and you say, how do people afford this? But obviously there's a huge amount of optimistic feeling. There's a feeling that as long as the credit card hasn't been refused, then there still must be okay to keep spending money. And I think it's also has been true up until now with lenders as well. And auto loans are I don't know the exact stats on auto loans, but I'm sure the auto loans are similar to CMHC at double what you'd expect with that population in terms of the intensity. nothing. It's really not uncommon talking to car dealers to sell a young guy a $100,000 truck, with all the $100,000 loan. It's actually not a $100,000 truck, but it's a $100,000 loan because they consolidate all his other loans and pay off the loan on his previous vehicle, which had negative equity, and then give him the new vehicle, and eventually now he's up to $100,000. But I would think that 2017 is the year that comes to an end. Because it's been a really grim 2 years now where the economy has been shrinking, and already this recession is worse than 2008, 2009 by quite a lot, and the unemployment rate is up in the 8 or 9%, and wages have come down. So at some point, but maybe it's just the lender shows up one day and says, "Hey, you know what? We're going to take back your house and your car," and maybe the people will be totally shocked that's what happened. Maybe they didn't see it coming, but they should see it coming because there's been tons of warning, about that.
We'll have more with Hilliard MacBeth right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're chatting with Hilliard MacBeth. Hilliard, car loans. Now, that's a hell of a way to grow your economy because cars, unlike homes, don't usually accrue value unless you have some kind of a collector's item.
Yeah, I think it's definitely the people selling the cars are only able to sell them with these amazing financing deals. So it's a desperation move on the part of the sellers. And I think they must calculate in the fact that at the end of at the default on the loan, because a lot of these guys are going to default on the loans, they'll have to take a loss. But sometimes short-term thinking is what drives people. If you have to make your bonus this month or your quota this quarter or the annual target for the year, and you do what you have to do to make it work. And it's been very good in actually in all of North America, but especially in Alberta so far. And it is surprising that it hasn't affected. There's been several. Just broadening it a bit out past Alberta, there's been several recent announcements by major economics groups that, and of course, it's driven by the big gains in Toronto of over 20% housing value growth. But David Rosenberg from Gluskin Sheff, Douglas Porter from Bank of Montreal Economics, Capital Economics, and a couple of days ago the Bank for International Settlements, which is the central bank of central banks, all came out and warned about the Canadian economy, the Canadian housing bubble, and the Canadian financial system. One thing that you and I both have noticed over the years is if it isn't actually real until Toronto notices it, right? So you could have a housing bubble and then a downturn in Alberta and a recession in Alberta for 2 years, but until Toronto actually notices it doesn't really count. Now they've actually admitted that there's a problem, and that's a new development. I haven't seen that before. The only one of that list is Capital Economics. They've been pretty bearish on housing for much longer than the 2 years that my book's been out. And but the Bank for International Settlements is an very interesting report. It comes out quarterly, and this is the second time they've warned about Canada. And there's four metrics. They have house prices going up too fast, which obviously Canada qualifies, and they've got debt, or they call it credit, but total debt level going up faster than GDP, and Canada made that measure as well. And difficulty in servicing the debt if interest rates go up 250 basis points or 2.5%, and Canada was flagged on that. So there was three warnings, and the only there was no country with 3 warnings out of the 4 possible categories, other than Canada, and China and Turkey were the only 2 that had multiple warnings, and then there was 5 out of the 20 that had 1 warning. So Canada was mentioned as it was last year at this time as a country, and what they say is that any country that has 2 or more of these red flags is vulnerable to a financial crisis, or what they call the domestic banking strain within the next 2 or 3 years after the red flags are triggered. So that report has gotten quite a bit of notice. The economist, his name is David Rosenberg at Gluskin Sheff, has gotten quite a bit of notice because he writes a very popular, I think it might even be a daily note. And then the chief economist of the Bank of Montreal really got people's notice, a lot of notice a couple of weeks ago. So there seems to be a consensus forming around this thing. But if it's anything like Alberta, it might be quite a while before people see the actual impact of it. But it really would be a good idea for people to take heed of these warnings. It isn't just me now that's saying it. There's lots of other people saying it as well. And one of the ways that people can keep up with this is by subscribing to our weekend note, which you can find at macbethgroup.com. And this week we'll write up a piece on this Bank for International Settlements warning that's come out. And every week we try and do a different topic. And it isn't always just about housing. Sometimes it's about the stock market and that sort of thing. But
well, Hilliard, with this kind of a warning, what can an ordinary person do to protect themselves if these warnings come true?
Well, first of all, anybody that has housing that they really can't afford, in other words, if they've got a lot of debt and they were buying real estate or housing or rental properties on the bet that prices would rise, then they should take action. They should sell and get that debt reduced, if not completely eliminated. That would be number one. There's an awful lot of people, obviously, in Canada that have bought on the basis of future price increases, not just as a place to live. And those people, if these warnings turn out to be true, and I'm sure I'm confident they will, then those people, they've milked it for all they can get now, and now's the time to stop trying to get drain that last piece of that last drop of blood out of the thing. Just a lot of people in Toronto, Vancouver will have good profits, and so now's the time to take the profits, in my opinion. The second thing is to look at your stock market holdings and make sure that you don't have a lot of exposure to the part of the stock market that is exposed to the residential housing market, and that is definitely in the financial sector, which is the biggest sector by far on the Toronto Stock Exchange. The lenders in total, which is mostly the big banks, are 35% of the Toronto Stock Exchange, but the profits from the lenders are more than 55% of the total profits on the Toronto Stock Exchange, and most of those profits are come from lending to Canadian households, including those $1 million loans to 32-year-old couples to buy a house in Vancouver, and those $100,000 car loans to some oil worker in Alberta that's probably just about to be laid off from his job if he hasn't been already. So it would be really important to avoid exposure to that section of the stock market. And of course, the other one is the Canadian dollar. So the Canadian dollar, it dropped to about 71 cents in just around the time that the oil price was collapsing in 2014, 2015. And then it rallied right up to 78. It's back now down to about 74 cents. So I would think that a significant amount of further weakness in the Canadian dollar is in store if these predictions turn out to be correct. So that would be a way to protect yourself, would be to try and move some money out of the Canadian dollar or reduce your exposure to the Canadian dollar if you can by buying other currencies, moving assets to other currencies, either in Europe or the U.S. or Japan or something like that. So it's easier than it sounds complicated, but it actually, with some good advice, it is relatively easy to do nowadays with the global financial markets being the way they are.
Hilliard, fascinating. Thank you so much for chatting with us.
It's a pleasure.
My guest has been Hilliard MacBeth, author of several books, including When the Bubble Burst, Surviving the Canadian Real Estate Crash, his website, macbethgroup.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet, Our popular YouTube channel is Talk Digital Network. Questions for the show can be emailed to info@howstreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.